Okay, so Ben's question is related to the picks of the day. Picks of the day are available for covered calls and for the cash secured naked puts, or cash secured or naked puts, the monthly picks of the day and the weekly picks of the day for both series. What is this? I had mentioned earlier that this is what Ernie had put together using the various iterations of different stock and option criteria, testing over various time frames, looking for things with higher implied volatility and lower implied volatility, avoiding earnings between now and expiration and not avoiding earnings between now and expiration, certain stock price ranges, things of that nature. So what he did is he developed the criteria that worked best over a trading cycle for weekly covered calls, weekly naked puts or cash secured naked puts, monthly covered calls, and monthly naked puts as well. And of course, what he did there is after he ran the iterations, I clicked the link to see how we developed these results. And for the weeklies and monthlies, he's looking on the Monday, usually later in the afternoon, is how the testing was done, looking not near the close, but sometimes around 1 o'clock or around 3 o'clock for the different monthly or weekly covered call picks of the day and more. Okay, so that's how he developed these. And what you're seeing here are the top 2 or 3. When you go right into the main link for monthly or weekly picks of the day, you're seeing the top 2 or the top 3 that match that criteria, and the update time is posted. They are updated daily. Monthly picks of the day for covered calls are updated around 11 o'clock Eastern time. Weekly picks of the day are updated around 1 o'clock Eastern time, the top 2 results that match when that search was run. Weekly naked puts, 3 o'clock Eastern time, and the monthly naked puts, 11 o'clock, same as the monthly covered calls. However, if you're concerned that you logged on to power options at 3 o'clock, I'm sorry, let's go back. I'm sorry, weekly covered calls. You're looking at weekly covered calls, let's say Ben, okay? And it was updated at 1 o'clock, but you log on to power options at 3 o'clock on Monday, and you don't even know if these are still near the same prices where you can get the premiums that you want for these slightly in the money calls that give you good protection. In that case, Ben, just go into the search and go to the drop-down menu here for our defaults and click on weekly picks of the day. We saw Affirm was at the top for the weekly covered call picks of the day on the report that was run at 1 o'clock. And we had the other position there as well. And so now it's changed. AMC is now the top one with Affirm, and then Upstart at a higher price. And you see some lower ones here as well. Returns looking around 2.3, 2.2% for 7 days with a good probability of getting assigned 70%, 68% and earning that return. So they're only updated once a day, Ben. You are correct. They might still be good, but the prices might have changed. If you want a more accurate depiction because you logged on at 3 o'clock when you were able to do your trading, in that case, Ben, what I would do is go into the search and pull up the default search. It's the exact same criteria. And if we decided to refresh that static weekly picks of the day view or monthly picks of the day view, Ben, they would change. If we updated from 1 o'clock to 3 o'clock or 1 o'clock to 4 o'clock, we'd be showing these 2 trades now instead of Affirm and Upstart, I believe it was, when we first opened the standard static view under the weekly picks of the day. Quick link. Yep, Affirm and Upstart. So now AMC there is at the top. Okay. So unless there was, you're right, there could have been a big move, a significant move, or you can't get the premium that you wanted. It's sometimes better to use the search, especially if you're on the real-time or delayed service, since the update was 1 or 2 hours ago. A lot of times they don't change that much, but there was a slight change here, and you'd have to decide if you want to take the risk. With AMC, Affirm's been very strong. Upstart's been very volatile. It has strong volatility on that position. I've seen that come up in the bull put credit spreads. I've seen it come up on the calendar spreads as well. Okay. All right. Speaking of which, let's go to the naked put search and let's go to the search itself for John. And I'm going to go to the weekly picks of the day in this case. Okay. So John's question, naked puts weekly picks of the day have been great for me. What will they look like if and when the market turns south? All right. Even though we're looking for positions with good premium, to give us a good percent to break even on the naked put positions. Reasonable probability, but a good protection, or what in the naked put we call a percent to break even. You have to just assume they are not going to be as good as what you've been seeing, John, if the market starts to turn. And we had an example of this about a year ago. I believe it was, let's just take a look at SPX real quick. Close down Ally, go back here. I'm going to go to SPY. And we're just going to go to the chart. I'm going to use a custom. I apologize, John. I'm going to use a custom one here as well. Okay, and we're going to go from August 20th, 2020 to October 1st or 2nd. All right, there it is. That's exactly what I was looking for. I don't know how many remember, but this was a 10% decline in a 1 month period. It started mid-September. It was about a 3-week period, actually. It started mid-September, early September, I'm sorry. It was really about the 2nd or the 3rd. And of course, it lasted till the 24th. So about 3 weeks, 21 days in that case. Okay? So we're going to start on September 2nd and go through week by week till October 2nd or October 3rd. Okay? Just as an idea. Now, this might take some time because we're going to use the backtesting tool. All right, so I'm going into the naked put, and we're going into the backtesting tools. And we're going to select September 1st or 2nd, 2020, Mike. Okay, September 1st, 2020. I'm going to say, what if we had started with the weekly naked puts on September 1st, 2020? Weekly picks of the day. Now, this is when we're uploading all of the historical data. So sometimes it's, and ignore all of that. I apologize. Okay, that's trouble, things that I have to look at, the programmers put on my page so I can analyze how some of the searching is going if there's an issue at any time. The checks there, that's why you don't see this. Okay. Nicola, I know that's going to be a problem, right? I think they went as low as $8 at some point during this time span. But in any case, we've got some common stocks in here: Foot Locker, AMD, Western Digital, Apple. All right, so let's just go to see how they perform from September 1st to September 4th. So week 1 during this downturn. Not so good, huh? Now, we would have closed these positions earlier, but these still showed up for loss. What do I mean by that? In that write-up, John, on the weekly naked puts, it does say that if you see a stock fall 7% from where you got in, it was $41 here. So when it fell 7%, that would have been before 35. That's over an 11% drop. So we would have closed it before then, maybe still taken only a 3 or 4% loss instead of a 9. Same thing here from 159 to 134 in that case. All right, so where are we though? 47% success rate on week 1, 7 out of 15 trades, loss of on average of 3% if we had opened all 15 trades. At that same time, the QQQ was down 5.8% in just those 3 days. SPX was down 3%. So it's kind of going with the market in a sense, isn't it? Let's go to week 2. So we expired on September 4th. So our next cycle would have been September 6th. I'm sorry, 8th. Extra day there for Labor Day weekend. So for the next cycle, that would have expired Friday, John, closed on Friday. We would have opened the following Monday or Tuesday, I believe, on September 8th for the next expiration cycle. Nicholas still in there, excuse me. Beyond Meat, Five Below, General Motors got some new stocks, JD.com. Calculate the group results, September 8th to the next expiration cycle. During the decline, one big loss. We wouldn't have taken that big loss, would we? If possible. What do I mean by that? Stock was at 50.05. It ended at 32.13. If there was a one-day drop, which is possible with Nicola during this time period, John, we might have not been able to close if the stock fell 7%. So we might have taken this loss if it was a black swan event. But everything else did pretty well, and it was stable. Okay, so from September 8th through September 11th of 2020, no real change in QQQ, 0.2% up, 0.3% up, 87% success rate. Remember, the market is still declining slowly. It's still going down. It lost 10% during this 3-week period. But September 8th through the 11th, you did have an 87% success rate, but it was an average return loss of 1.1%. And again, that's because of this Nikola position that took a tumble. And I can't remember if we would have caught it and gotten less result. I might look that one up later to get further analysis for you, John. Let's look a little bit deeper. Would we have closed the NKLA position following the 7% stock rule and avoid taking that 27.6% loss we just saw in the historical backtesting? Following the write-up in Ernie's See How We Develop These Results, he discusses that you should consider closing the weekly naked put picks of the day if the stock falls 7% from when it was open. Now, the position we just saw, Nikola was open. The stock was at 50.05 on September 8th. The 11th of September 49 put was sold at 3.35. This was an expectation of a 6.9% yield as long as NKLA stayed above $49, of course. 3 days later at expiration, the stock was at 32.13, and the put had a buyback cost of 16.67. So this was a loss of about 13.32 on that one position, or 27.6% of the $49 requirement for the cash secured naked put. The day after the trade opened, Nikola was at 42.37. It gapped down at the open. This was a stock loss of 15%. But at that time, the 49 put could be bought back at around $7 or $7.25. We still kept the 3.35, so the loss on the put was only 3.90, not 13.32, and this was only 7.9% loss of the $49 requirement. Still a loss, still a gap down that couldn't have been avoided, but following the 7% rule, we would have gotten out at a much lower loss. And taking only a 7.9% loss on that position when it gapped down instead of a 27.6% loss, this would have made the return for that particular cycle from September 8th, 2020 to 11th September 2020 a gain of 2.9% instead of a loss. And of course, we still kept the 87% success rate. That didn't change. Looking back also on the previous cycle from September 1 to September 4th, NKLA was on the list again, and it was closed at expiration on September 4th for a loss of 9.6%. However, following the 7% rule, the day after the trade was open on September 2nd, the stock went below the put strike price and pretty much hit the 7% rule. But if closed at that time, the loss would have only been 1.8% instead of 9.6% if it was held through September 4th expiration. Similar to ZS, Zscaler. Held all the way to expiration on September 4th, that was a loss of 11.8%. But on September 2nd, the day after the trade was opened, and the stock fell to 7% down to about 143 from where it was at 159, the loss would have been half. It would have only been 5.9% if closed at the 7% rule. The first cycle still would have been a negative return. It wouldn't have changed to positive, but the losses would have been significantly less following the basic rule of closing out the weekly naked put picks of the day if the stock falls 7% from where you initially got in. So let's keep it going. So now, where would we go? September 14th? Yep. It would have come up in our top 15 on September 14th, going through to the 19th, I believe. 18th, excuse me. Completely different stocks. Co-Diagnostics, not the top 5 that we've seen. Beyond Meat's there again, further down. ADS is in there. But again, looking like different stocks each time, it would have been okay. All right, let's take a look at what we've got here. Not too bad, looking pretty good. 73% success rate. 11 out of 15 trades during that time period. 0.3% return, not great. We got some losses in here, but again, we might have managed this better. 36.10 on CWH down to 30.06. Probably would have managed before that 20% decline, technically. Hopefully. The one down here, 29.96, that's not too bad. That's about a 10% decline A little bit less. Yeah, it's right about a 10% decline from 29.96 to 27.17, excuse me. So we might have been able to lessen the loss on this one, but still turned a small profit with the weekly naked puts through the 18th, even though Q was down 3.1% over the same time frame, SPX was down 1.9%. So kind of performing okay, but you kind of expect it to perform with the market. In general, if you start to see the market go into negatives and we start seeing SPY dipping below its 50-day moving average and it's getting towards the bottom Bollinger Band and riding that in that case, we might want to consider not doing. I wouldn't be doing bull put credit spreads at that time. I've got rules for that when I see the general market indicators change. I wouldn't be doing covered calls and I wouldn't be doing naked puts. I'd wait to see the bottom and then start going in. But as we see, we did take some losses there, but it wasn't as bad as we would expect, even though the market was down 10% over that time period. Let's just see the last cycle real quick. It was towards the end of it. We'll run on the 21st, following standard expiration. Okay, and oh, that's not what I meant to do. Sorry, folks. Here we go. Novavax, Canada Goose, Foot Locker. Okay, so here was those results again there, a 0.3% return for that cycle. Now we're going September 21st through the next expiration cycle we had, which was the 25th, right at the end of that 10% decline in that case. I'm sorry, since we're loading everything, John, it's taking a while. Now, an interesting thing while we're waiting for these last results to come in for September 21st to September 25th, I had to remind myself what discussion it was, but about this time, October, November of last year, we did a webinar where we were talking about the decline that we saw, the 10% decline in SPY during this time period, and which hedges would have worked best. And because the decline was significant, it was a 10% correction. You know, we were at 355 here, we dropped all the way down to 320. So what we saw happen here in this sort of, at the worst part, the 10% decline, because it was gradual, and yes, this was a big move, and this was a big move, but this continued, was very gradual, was over a 3 weeks period. The VIX and UVXY and VXX, the volatility ETFs, did not give a good hedge. Buying calls on the VIX, shares of UVXY or VXX did not give a good hedge because this was a very gradual decline. Although it started off strong, but it was considered very gradual. Buying puts on SPY and buying puts on QQQ were better hedge for this type of decline. When you have a black swan event, that's when the volatility indexes really work great as a hedge in that case. All right, but our results here going forward, perfect. This is what you've probably been experiencing the past few cycles, John. Of course, QQQ rebounded, was up 1.5%. SPX was up 0.5%. The weekly naked puts, 13 out of 15 of the top 15 would have been an 87% success rate in that case, 1.4% average return with a couple of small losses in there, 0.3% on Capri Holdings, 0.6% on Foot Locker. Everything else was a profit of 0.8% or greater in that case. So still performed pretty well at the end, as we'd expect, neutral to bullish, stable market after that decline as well. I was kind of impressed with the 21st, the 14th through the 18th that had a 0.3% return there, even though SPY was down, was at 1.9%, and QQQ was down minus 3.1%. That's pretty impressive. But again, if we're still in that declining mode in that case, you might want to consider, you might want to consider not doing the weekly bull puts. Wait a week or two until you see some stability, John, and then start doing the weekly naked puts, weekly covered calls, potentially the bull put credit spreads again, once you think you've hit a bottom range.